I'm Rafe Benson, co-founder of online pensions and investments advisor MoneyCube.ie. This year, it's been impossible to ignore the markets. Driven by inflation, war, supply chain shortages, there's been significant declines in most markets, followed by a partial recovery over the summer, which itself is now unwinding a little bit in September. Many of us have seen significant declines in the value of our pension pots. Whether it's market ups and downs, new investment opportunities, or new attitudes to existing investments, having a grip on how your pension is invested can make a significant difference to your wealth. This session looks at how people should invest their pension money in 2022 and beyond. Firstly, we're going to consider what has happened in the markets over the last 12 months and to make sense of them from a pensions point of view. Secondly, we'll look at the outlook from here. Which regions of the world are hot and which are best avoided? Will there be recession in Europe? Should you reallocate in or out of equities? What's the outlook for other asset classes such as commodities, bonds, and more speculative assets? And lastly, how should you as an investor respond to this? Should you react at all, or is that the job of your pensions advisor or your fund manager? This discussion is coming to you from Davy here on Dawson Street in Dublin, where they've kindly provided us the use of their boardroom, and we've got a distinguished panel for you today to talk about all these questions. As we do discuss these questions, it's important to say that none of what we're discussing today represents personal advice. We're recording this a few days in advance of Pensions Awareness Week itself, and in any case, everyone's situation is different. So, there are plenty of resources on the pensionsawarenessweek.ie website for further guidance, and plenty of sources of advice that you can find through that website. But in terms of our discussion today, it's general in nature. Joining me today on the panel are experts from across the Irish industry, all steeped in investment markets and the world of pensions for more years than they are likely to admit to today. Gary Connolly is Head of Investment Advisory at Davy, Ireland's largest stockbroker. Gary set up and subsequently sold iCubed, an investment consulting business, to Davy in 2014, and these days works with clients to make sense of investment markets and build out investment portfolios. Ian Slattery is Head of Investment Solutions at Zurich Life, the major Irish pensions and life assurance provider. Ian's responsibilities include producing Zurich's investment commentary and insights in the Irish market. And he is current president of the Irish Institute for Pensions Management. And James Skehan is former head of pensions at New Ireland. These days, James acts as an independent professional trustee and advises employers and trustees on pensions matters. And James is also teaching a new generation of pension and investment experts as lecturer at LIA for people working towards the Certified Financial Planner qualification in the Irish market. So he's also with LIA, one of our supporters during Pensions Awareness Week. So if we stand back from it, the outlook at the beginning of 2022 looked very rosy. It's hard to remember now, but the talk was of the roaring 20s, the great reopening of retail, of businesses able to reconnect with their global supply chain, and all the pent-up saving that had been done during the long months of lockdown in the preceding 2 years. So there was a degree of optimism in the air. But I guess, Ian, the first signs that wasn't panning out were to be seen in the equities market, which has seen significant falls from pretty much the start of January.
Yeah, so equities did hit an all-time high actually on the first week of January on the back of a very strong 2020 recovery from COVID, and that continued through 2021. So there was a relatively optimistic view of markets at the start of the year. This idea of supply chain blockages and this pent-up demand was always in the background, and would inflation bite? But the general view was that inflation was this phrase transitory. It wasn't something to worry about from a fundamental perspective. Obviously, towards the end of February, we had the Russian invasion of Ukraine, and looking at that through a purely economic lens, that does accentuate inflationary powers in terms of the role Russia plays in commodity markets. If we kind of bring it through from February, then we had the inflation start to bite even further. Inflation fears kind of manifest themselves then into the thought of higher interest rates across the developed world from central banks. I'm sure that's something we'll discuss a bit further. And the potential for these higher interest rates then starts to get people to think about maybe we're going to see the brakes put on economic growth. So you have inflation, interest rates and economic growth all kind of working together to maybe bring a little bit of pessimism to markets. So equities have had an up and down year, as we expect from one of the more volatile asset classes, and did see a very strong recovery throughout the summer. But as you mentioned in some of your previous remarks, that's kind of come off again into August and September. Currency is important in equities as well. We have seen the stronger US dollar versus the euro, and that has kind of softened the blow for global international equity investors, which most people would be in the Irish space in terms of multi-asset funds. So equities are down year to date, a little bit less in euro terms, but very much a volatile year so far. But I think some of the forces that I've mentioned there have really played out across a wide range of asset classes. And when we talk about multi-asset funds, that plays into the likes of bonds and commodities and alternatives as well.
That's right, isn't it? And I mean, I guess you've mentioned interest rates there and banks, I guess, being slow to act. But Gary, is it fair to say that inflation is the big news story of 2022, and bank reaction to that is what's driven not just equities but other asset classes too?
I think it's more than fair. I would say the inflation debate is the sole thing, largely sole thing driving markets so far in 2022. I mean, it's been an extraordinary. I know that's an adjective that's way overused by financial market commentators, but I think its use is absolutely apt to describe, bond market developments in 2022. I mean, it really is. Extraordinary. I mean, whatever about stock markets, and there's been lots of developments there, but in bond markets, it's just been an extraordinary sell-off. And probably emblematic of that is in Austria in 2020, they issued a century bond. So so it's not payable. So it's not. So the capital is not being returned until 2120. So in 98 years' time. It was issued at a paltry yield of 0.88 of 1%, and that bond today is trading at about 45 cent in the euro. Now it went up to about 130 or just north of. So peak to trough, that's a loss which is just incredible.
So some people have lost 2/3 of their money on that bond. Is that right?
Well, it's certainly anybody who bought it at peak. Anybody who bought it at issue is down 55%. Currently, anybody who bought it at peak is down 65%. Now that's the sort of loss you expect when you buy speculative equity, like Netflix would be down a similar amount. So when I buy an equity like Netflix, I buy into the potential for extraordinary returns, but also that sort of downside. You don't expect that when you buy a government bond. Lending to a AAA rated government like Austria should be like watching paint dry. It should be the most boring element of financial market investment, but it's just been an extraordinary, as a lesson in kind of duration risk. It's just been an extraordinary time. So that's now reflected in bond market returns, which have been really, really poor this year, and unfortunately, then for more cautious investors that have. That have diversified their portfolios out of equities into bonds, they've actually fared worse than those that have just been invested in equities. So pretty extraordinary.
I think that's something we'll come on to is that ordinarily you would hope that there's a degree of cushioning of risk if you're split across those two primary asset classes, but it hasn't panned out that way, certainly this year so far. So I guess, James, it falls to you to hopefully inject a note of optimism in terms of reviewing what's happened so far, but I guess one of the key things that's happened in response to the inflationary pressure is that belatedly, arguably, central banks are pushing up interest rates, and because they're a little late to the party, they're doing it quite aggressively, quite quickly. So if we were to see a positive side to that, one option for pension savers that's been really off the table for years for many people is purchasing an annuity at retirement, a guaranteed income for life. But the interest rate changes are having an impact on that market.
Absolutely. Annuity rates are probably the one good story for the current year. Like in the first 6 months, annuity rates have improved by about 25-26%. Now, one of the problems there is, though, it introduced the whole concept of timing risk. So if the same person with 100,000 bought an annuity on the 1st of January, they would have bought 25% less than someone buying on the 1st of July. So that's one of the big problems with annuities. But the other, I suppose, strange thing that happened during this year is that to protect the purchasing power of an annuity, you should invest in long-dated bonds. The problem is, though, long-dated bonds dropped by 25, 26, 27% over the same 6 months. So you're still able to purchase the same amount of pension, but trying to explain to an ordinary individual that their fund has dropped by that much in what they would have thought was a safe fund is a tough job.
Yeah, yeah. And is there anything that one can do to protect against that timing risk?
Yes, probably the way to do it, if you can get at and invest in an ARF, because an ARF in turn can buy an annuity at any stage, in part or in whole. And certainly as an individual gets older, it is certainly something that an ARF investor should look at, because you're securing and guaranteeing a certain amount of income, as I say, as you get older and perhaps have less tolerance of risk.
Yeah, no, it's a great point, and it's probably not for today's session, but we do have another discussion through the week on pretty much exactly that topic, and I guess that's something that we haven't probably seen play out in the post-retirement market quite yet, because the generation that have been capable of buying those retirement solutions are only beginning to retire. But I couldn't agree more. Yeah. So if we return to this sort of this fact that both equities and bonds have been falling, kind of in tandem through the year, how? I guess where's the solution there, Ian? Like what is going through? You mentioned multi-asset funds. What is going through the fund manager's head as that is happening, or what are your colleagues at Zurich kind of doing to kind of take account of that trend?
Yes, so multi-asset funds which invest across equities, bonds, and sometimes other asset classes as well. There's this kind of classic idea of a 60-40 split, so 60 equity, 40 bonds, which has served people very, very well for decades. But you have this kind of twin bear market of equities and bonds, and that kind of model, at least in the short term, has fallen apart a little bit, particularly in 2022. And to Gary's point, that can be particularly hard for lower risk investors to kind of get their head around, because they thought they were in the safer asset and they're seeing relatively larger falls. So I think there is always things you can do. You can always look at the asset classes in terms of their absolute valuations. So just looking at equities in isolation, is it a good place to be? But what you're doing as a fund manager in a multi-asset fund is you're choosing one asset over the other. So this idea of relative valuation. So even if you think equities may still be in for a little bit of a tough time in 2022, you can still favour equities over bonds if you think they're going to do better than the bonds. Now, in terms of absolute returns for customers, that can be a bit of a tough one to kind of deal with as well. I think the duration risk, which we've kind of discussed already, I think that's very, very important, where you can kind of actively reduce that duration risk, and you have to make that call correctly. But you can do things to mitigate the effects of that interest rate environment as well. I think it is important, though, that people kind of stick with risk. Even if you do see deposit rates start to shift up slowly as interest rates shift up, always try and look at real returns, which take into account the effect of inflation. So even if you see your headline deposit rate as a customer going up, your actual purchasing power is still being reduced by inflation. So there's always opportunities. Volatility always brings opportunities. It is a tough time, though. It's a tough time to be managing in the market at the moment.
For sure.
It also brings the old pound cost averaging principle into the equation, because if you're paying regular contributions on a monthly basis, you're going to be buying units at a cheap price. I think crucially, the age of the investor is all important.
Yeah. So tell me a bit more about that then. Like how might it make a difference if one is 5 years away from retiring versus 25 years away?
Okay. Well, I think 25 years away from retirement, I wouldn't be bothered at all about the market downturn. You have time on your side, and as I say, the contributions you're paying on a monthly basis will be buying more units. Equity markets always recover. It's a question of when and how long will they stay in the doldrums. So if you have time on your side, 5, 10 years plus, I wouldn't be worried about equity markets at the moment. The closer you get to retirement, you should be running for cover. But a key part of that is matching the funds you're invested in with the benefits that you're likely to take at retirement.
Okay, so again, I'm going to explore that a little bit
Okay,
further. So
sure.
Are you talking about in terms of the plan to draw down funds, and remain invested in markets versus the annuity we've spoken about?
Yeah, and again, I suppose the benefits taken at retirement will still be driven by what tax-free lump sum you can take out. And unfortunately, we have a slight, conundrum here in that there's two options at retirement. Most people in group pension schemes will still get the better lump sum using the salary and service route, and that in turn will mean that they will have to buy an annuity. So in that situation, they should be aiming to end up in cash, a mixture of cash and long-dated bonds as they approach retirement. On the other hand, then probably the business owner or those individuals with bigger funds will be looking towards the ARF. And in that case, there should be sort of a 25% of the fund in cash at retirement. And probably the balance, I think investors take two views. Really and realistically, they should be looking at a time horizon until they're 90. But a lot of Irish people will look at the term up to their retirement date, take the lump sum, take stock, and then reinvest. Mm-hmm. So again, it's down to giving individual advice. And I think one of the key points in the current climate is people need advice.
Mm-hmm. Well, that's very gratifying to hear as someone who does it day in, day out. But you're certainly right. There's a huge amount of data out there that says we routinely underestimate the time we will spend in retirement, and very often you're talking to a client and saying, this is money that you might be spending in 30 or more years' time. So I guess time is our perception of time isn't always matched up to how it plays out in reality. But speaking of time, then I guess we talked about inflation. Like, what is the outlook, Gary, for inflation? I mean, can we begin to speculate on when it might end? When it ends, will it plateau and we're just at a new level of prices of goods, or are we contemplating deflation, and how does that impact on markets as a whole?
Look, I think it's the key issue for in terms of when will inflation return to tolerable levels, because we've become used to over the last 40 years generally disinflation, so inflation that might have been high in the late 70s, early 80s, but declining pretty much over the last 40 years to the point where we were more worried about deflation 3 and 4 years ago than we were about inflation as we are currently. The market, if you look at inflation kind of futures, the market seems to be fairly complacent about inflation 5 and 10 years out. It's still only pricing in 2.5% to 3% inflation in the US. We've just had an inflation number close to it got over 9% in the US there fairly recently. So that suggests a big climb down in inflation, the market's expectation of it over the next number of years. Look, it's a great imponderable. I think though it's inextricably linked to a point that Ian made about thinking about risk, because to me. And inflation is such an important part of it, because when making any investment decision, I think the key question to ask is, well, what risk am I trying to manage? And that's inextricably linked to, well, what is my objective? What am I trying to achieve? And usually, because the answer to that question is so important in terms of the ultimate investment strategy that you take. Because we intuitively, or maybe not intuitively, but we were conditioned to think about risk as being volatility and short-term capital loss, and that is a risk. If my time horizon is 1, 2, 3, 4, 5 years, yes, that volatility and short-term capital loss is the appropriate risk, and I need to manage that. To manage that, I'm going to invest in assets that protect me from volatility and short-term capital loss. That's cash and bonds. So we intuitively think of those things as kind of low risk. The issue or the problem gets more tricky when we think about, well, what's the appropriate risk for a long-term investor, which is somebody in a pension, and to me that's purchasing power and inflation. So money, the best definition of money is purchasing power, because it's ultimately money is a means to an end, and if that end is my spending habits, if they're inflating at 5% per annum every decade, I'm losing 40% of my capital. Now, if that's the risk that I'm trying to manage, then what's low and high risk actually inverts. So what has protected me against inflation? Well, it's real assets, infrastructure, property, and equities. So they're low risk in that context because they've protected me from that risk I'm trying to manage. Yet that we find that very, very difficult intuitively just to grasp, because we're conditioned to think about that risk as being the variability and the short-term capital loss, and we just need to, I think, to get investment decisions right in the long term, we need to break those two things down and separate out goals. So a pensions goal, your risk is inflation, maybe for short-term university funding or school funding, maybe it is, maybe cash and bonds are low risk in that context, but not, like as somebody said, I was at a conference a number of years ago, and the statement was made, every fund is high risk if it's misused. Cash and bonds are high risk if they're misused. And if you're a long-term investor in cash or bonds, that's high risk.
Just to come back on the idea of where inflation has been and where it could go, if we look back at much of the last decade, it's averaging in around zero. just give or take in the Irish context. And I think whatever you say about forecasting inflation for the next decade, it's going to be higher. It's going to be higher than zero, okay? So it's not going to stay at the 8 or 9 that Gary referenced. But even if it gets under control and it kind of oscillates around 2 or 3% for the rest of this decade, that still brings Gary's point about the type of fund you're invested in very much front and centre of it, because he could almost have got away with not taking enough risk, relatively speaking, given the interest rate and deposit rate environment we're in. But no matter how, and we'll touch on this again about how central banks maybe get this under control, it will settle at a higher rate than it has been in the more recent past.
And it's almost been like that fund managers haven't had to think about inflation as an investment driver, in fund allocation. Like so, like I was talking to a colleague who manages funds focused on retail. You look at a company like Procter and Gamble in the US, they pushed their prices up 6 times in the last 12 months. And it's just great, very liquid, all this kind of stuff. Like people will pay for it, Whereas up to now, I think that they haven't derived much benefit from that in a non-inflationary environment. Suddenly, that's a really popular place to be. Or some of the big insurance companies chucking out dividends of 6-7%. So I guess that's going to play into the composition, at least of actively chosen investment funds. Is that fair to say?
Like if you look at the darlings of the market in 2020, were these sort of companies that capitalised on, say, work from home, play from home, deliver to home. And some of them were more traditional businesses that were able to, just based on the very unique scenario we're in, the scenario you're talking about there about the inflationary pressures, it comes down to what's a discretionary good for someone and what's a staple. Like what you need to buy. It's your very liquid, it's your toiletries, it's your household goods. What do you perhaps not need is your premium subscription service on a monthly basis. So that's where, when you look at, say, that you can split them up different ways, the 11 main sectors of the stock market, there are ones that will do well in certain environments, including inflationary ones, and there are ones that won't fare as good. And that applies to bonds as well.
And I guess, I'm sure many of the people watching are investors in funds run by Zurich, but I guess Zurich here in Blackrock in Dublin runs 30-odd billion quid of money directly, and has always made a strong play kind of for active management. But I suppose this is one of those markets where, you might have thought passives would fare worse because they would be over-indexed on those, as you say, darlings of the stock market over the last little while, whereas an actively chosen fund can afford to forego the Tesla or whatever it be, the more volatile and the more the meme stocks, what have you. So have you found that as a fund house over the last 12 months?
It can be tough on certain equity books when there's volatility happens. I suppose we can kind of get lost in the active v passive debate for a while, but we kind of look at it as there's 3 levels to it. I suppose the level a lot of people discuss is within a single asset class. Do you want to have an active exposure to the US, or do you want to buy the market? There's probably 2 levels above that. I suppose one is your asset allocation. So how do you decide between the equities and the bonds and the property and things like that? The process behind that is really, really important, and having a long-standing process has been a benefit to us. And James will be closer to the top layer is around your default investment strategy, or what options as a trustee or an employer you give pension scheme members and things like that, because that in itself is an active decision. So there's probably 3 levels to it, and you can kind of talk about each of them individually, but if you don't get the default and the funds you're offering right, your asset allocation right, the third bit, I suppose, can matter, but perhaps not as much as the first 2.
I think that's a fair point, and although I don't think we should get lost in that, and I'm hoping if we do, you'll pull us out of the thicket. I think the point that often this question is like an either or, whereas what you're saying is actually it might be yes, here I'll be passive, but actually if I'm choosing investments in the Vietnamese stock market, I'll probably want to be active, or with the guy who's on the ground there, or whatever it be. So I guess that brings us on very nichely, James, to the the kinds of funds that many people who are in corporate pension schemes will be invested in, where typically you've a choice of can be quite confined, actually, 3 to 5 pension funds perhaps, of which one is a default, and very often is a default kind of lifestyling type strategy, which is designed to de-risk, or at least make less volatile, your pension money as you approach retirement.
Sure.
Okay,
yeah. So in a group pension scheme, default investment strategy is king. Okay, the views vary, but it's somewhere between 80 and 95% of members are always invested in the default investment strategy.
It's a brave person who opts out.
Well, absolutely. Now, whether that's as a result of apathy or lack of engagement or whatever, but that's the reality. Now, the default strategies in the Irish market are broadly similar. Okay, in that in the early years the emphasis is on growth, and albeit risky investments, but again you've time on your side. And then they all basically have different landing points. So over the last 5 years, you can either run to a situation where you're 100% invested in cash, 75% is, say, a mid-risk fund, and 25% cash for the ARF investor, or a long-dated bond fund for the purchase of the annuity. The difficulty is, though, that at that 5-year out stage, there needs to be engagement. And my experience in looking after, with my trustee hat on, is there hasn't been that engagement. Again, whether that's the fault of the member or lack of engagement from the advisor. There is one system out there that will automatically switch a person to the mix of funds that will match their benefits based on the optimum tax-free lump sum. And that takes away an awful lot of the concern and worry from a member's perspective. So in terms of where should a default investment strategy invest in, typically it will be, in the early years, it will be 80-90% equities, or maybe 80% equities, 10% bonds, 5% cash and 5% property. I suppose the question I'd like to ask Ian and Gary is, with equities being so volatile at the moment, why has there been so little investment in property? And is that kind of a route to go going forward, albeit knowing that you can't have more than 50% invested in property because of the IRP requirements? But property would seem to be, equities and property have always been considered to be the real assets, but yet your typical pension fund will only have perhaps about 5% invested in property. Yet business owners...
James is making my job easy for me here. I don't know if you have any comments on that topic.
Yeah, can I just come back to that? I'm not trying to avoid it, but I just want to go back to the kind of 60-40 target date thing, because I'm not the greatest fan of target date funds. Because the whole notion of 60-40 and target date is the fact that, bonds and equities don't go down together. And this lesson, that we've had this year is just extraordinary in terms of, it really tested that. So, and I think it's reasonable to expect that in the future, probably bond and equity correlation is going to be higher than we've been used to. So central banks are, they are... focused on, getting rid of inflation and not so much on supporting growth. That's a very different environment than we've been in for the last 10 or 15 years. So I think it's reasonable to expect that. And target date funds, are kind of valuation indifferent or agnostic in terms of they automatically switch you out of equities into bonds irrespective of price. And I just think that's, I don't think that's right. I think there should be.
Time, even although you might be close to retirement or relatively approaching retirement, you might want to stay overweight equities because...
Well, yeah, I mean, if I was 2 years ago, at a trigger point that was taking 20% out of my, or 10% out of my equity allocation into a bonds that were negative yielding, I'd like to have had some oversight in terms of the price at which I was buying them. So anyway, I think there should be, I'm not a particular fan of target date funds for that reason. But to the point about property, property's been great this year. Infrastructure's been great this year. Cash, notwithstanding negative rates on deposit, have actually been a great place to be this year. Now that's hindsight, obviously. Maybe funds are underinvested in property, but we do you have to remember it's extremely illiquid, and. I'm a fan of real assets, not just property, infrastructure, commodities to a certain extent. So I'd be more of a fan of a broader basket of real assets rather than just property. But property should form part of that. And arguably, there's a case that maybe pension funds are underinvested. But I think cognizant of the illiquidity, and we've a history here. Particularly in Ireland, of we own lots of property outside of our pensions, so it's reasonable for people maybe to think, well, I have enough of that in my holiday home in Rosslare and my house in Dublin and whatever it might be. So that would be my take on it.
Yeah, I tend to agree. As an advisor, you often find typically most people's largest asset is their house, the house they live in, but often they look at property as an investment class, like direct investment. So as a nation, we're probably overweight property, but then I guess property itself is is a very broad asset class, and there's a great deal of difference between, I don't know, owning a piece of a mall in a Midwest city versus a big box retailer type asset in continental Europe, or I don't know, a public-private motorway in Ireland or whatever. So they're all kind of they all have quite different trends, don't they? And it seems like it's a sector that's changing itself anyway, rising out of these working from home trends and decentralizing, all that kind of thing, So there's a bit to play there.
Sure. The other point you're making was the choice of funds and the number of funds that trustees make available. Like the Pension Authority's starting point is 5, 6, 7 funds. I think the balance is you need to understand your membership. And I think one of the reasons why most people stay in the default is they just don't have enough investment knowledge to be able to pick and choose a fund. So, as I say, it is a balance. But the crucial thing is to get the default right. And, getting back to Gary's point, there's no substitute for member engagement. I think that's at the end of the day what's most important.
Would you accept, James, that there's a degree of frustration there for the more engaged corporate pension member? They're bound to invest through the corporate pension scheme, and it's almost as if that scheme, understandably, has been designed for a relatively disengaged member, because actually as a regulator and as a society, we're trying to make sure there's good pension coverage, but actually it almost penalises the engaged investor who's sitting forward, might want to be using Davy's trading platform to buy any of several thousand liquid assets out there, for UK, for example, that would be very easy to do through a SIP. Do you see any?
Well, for a member like that, that's frustrated at the range of choice that are available, I suppose the one option would be to go the AVC PRSA route. So rather than pay the AVCs into the group scheme, one, you have a wider choice of funds. Two, you could well end up being with a different investment manager anyway. So there's a bit of hassle. You have 2 benefit statements and things like that. You have to keep an eye on both. But if you want investment diversification and the more kind of racy, sexy funds, well, then the AVC PRSA is probably the route to go.
Yeah, interesting. So it can be done, actually.
It can be done.
Yeah.
It's a tricky one, though, for trustees, because the thing with an average is nobody's the average.
Yes.
And you're trying to accommodate and make the right decision for the majority, but there's always a minority on the side, I suppose.
Yeah. I think it's a company pension scheme is a collection of individuals. Yeah. And that's the conundrum. That's the challenge.
Yeah, for sure. Okay, so I guess we can't have a discussion on markets in 2022 without talking about Ukraine. Primarily, obviously, a human tragedy, but also has huge financial implications for people around the world. So could we talk a little bit about how we mentioned it at the start as something that's provoked inflation, but is it being used to some extent as cover for an overbought market from 2021? And can we begin to sort of assess how much of the changes we've seen in markets this year are down to that, or is it just inextricably bound in, and we're all waiting until we get a resolution there? I might throw that one to you, Ian.
Yeah, so just maybe to provide a little bit more of the context from the economic perspective. Combine Russia and Ukraine in terms of the percentage of global GDP or the global stock market, it's minimal, relatively speaking, less than 1%. If you take their combined role in commodity markets, it'd be a lot bigger. So oil and gas are the stereotypical ones we think of Russia, and wheat within the Ukrainian context, but lots of other metals and grains as well. So that's been the bit that's been driving the inflation piece. Is it used for a bit of cover? I suppose it would probably fair to say, again, with the benefit of hindsight, when there's always 2020, that marketing an all-time high at the start of 2022 after a fairly benign and nice ride in 2021 probably said there was going to be a bit of a pause for breath. But I think what probably brings it still into focus is we've even seen in recent days and weeks the impact of individuals on this, and once it becomes a kind of the gas price becomes a political football, if it's within Russia or the Eurozone in the US, it gets very, very hard to apply any sort of fundamental lens to those sort of conversations. Because you wonder sometimes that the people making the decisions know what's happening, let alone trying to predict what they might do as well. So I think inflation, as we said at the outset, was kind of starting to bubble a little bit, and it has been accentuated. And once that happens, it does bring those more fundamental factors like interest rate policy, monetary policy, and the effects on economic growth. So,
And it seemed as if for a while there, like obviously, for example, the oil and gas supply chain was completely thrown upside down. So, where we get our refined fuels from, that all had to get diverted, and we're getting sourcing gas in our gas stations or whatever from totally different places than we would have been 12 months ago. It felt like over the summer that had been addressed a little bit, and the barrel price was descending after Joe Biden's visit to Saudi and whatnot. Lately, that's creeping up again, Gary. So I guess, are we just in an era, a 70s style era where we're going to have to reorient our economy around permanently higher
God, I hope not.
Energy prices?
Yeah, like stagflation is the thing I would be very concerned about. Whatever about inflation in itself is not necessarily a bad thing. At 8 or 9%, it's clearly a problem. But inflation itself, in and of itself, is not necessarily a bad thing. But like on the Ukraine, there was an energy crisis. Well, certainly an oil crisis prior to anything happening in Ukraine. But I think the inflation thing. Well, to me, like the economic war really between China, Russia, and the US has essentially, in terms of the globalized low inflation world we've become used to over the last 20, 30 years, those pillars have weakened a lot in the last 2 years. And Ukraine has been part of that. Because we've Russia, with all the commodities, we've China with all the factories, and essentially they have been two massive pillars of disinflation for the last 20 years. Those pillars are now gone. So I think we should probably become used to inflation, hopefully moderating from its current levels, but not reverting back to what sub 2% that we've had for the last 10 or 15 years. And that's just something, in getting used to that, you have to think differently from an investment perspective, if that's your baseline view. So that's the starting point. And I think it's going to be a much bigger part of the picture going forward.
Probably saw the idea of deglobalization starting to go back a little bit further. You can look at things like Brexit, you can look at Trump, the rise of nationalism, whatever phrase you want to put on it. But there's been even the pandemic made a lot of individual respective governments to think about onshoring supply chains, whether that be medical supplies or energy security, these sort of things. And that all adds to inflation. It adds to kind of weaker supply chains, goods having to move around a lot more before they reach the end consumer.
Yeah, it's this kind of move to just in case rather than just in time, so it's been characterised as.
But so the stagflation thing is most nightmare is maybe too long a word, but it's a stronger word. But it's definitely one of the key risks. And this is the idea where you have very, very high inflation, but economic growth stagnates.
Yeah, which
the good thing though is everybody's concerned about inflation. When everybody's concerned about this risk. You not that you become complacent, but everybody's talking about this is the risk. It's the risk probably we're not talking about are the ones that come to bite you and surprise you. So at least everybody's conscious of it and talking about it. And maybe that's not the thing obviously it's not going to surprise us because we're all talking about it.
Yeah, well, I feel strong enough to ask about the risks that we're not talking about after all that. But if we maybe turn to sort of some of the more opportunities or reasons to be optimistic around there. So that is probably the germ of one, isn't it? That, it's very clear that central banks are going to be resolute in getting a grip on that. And I suppose the quicker they act, the more we kind of hop through that window of getting a grip on inflation before economic activity has damped down excessively. But where do you see grounds to be optimistic, or where do you see investment opportunities in September 2020?
I'm a bit not weak on the, but I'm a big advocate of trying not to be too clever with all these things, like in terms of infrastructure has done well and property's done well this year, and energy sector has done incredibly well, and healthcare people are looking for resilience in the context of inflation, and I think there are pockets of you could look at very long-term secular trends like climate change and the green energy transition, like that's potentially quite inflationary, but potentially you could be very bullish about things like industrial metals, copper, aluminium, or lithium. In the context of that, climate change in general has, it's going to be a huge theme, and there are other pockets of opportunity. I'd say, as I said, I'm trying not to be too clever about it, but if being pressed, and I know I'm being pressed, I would say, within the equity space, I think value as a style and a factor has potentially big runway for opportunity because it's been out of favour for 10 or 12 years. AQR, which is a company does accept really brilliant analysis of this, has value. The disparity between the valuation metrics on value versus its growth counterpart are now in the 97th decile, which means they've only ever been more distorted on 3% of occasions. So it's an extraordinary disparity there, which means there's an opportunity for value, I think. So that's within the equity space.
It's worth saying. I think it's when you drill down to individual companies and think about how they'll fare in that. I use Microsoft as an example, right? So you don't have to comment one way or another, but just as here's a business that's been in, top 5 companies in the world, or top 10 equities in the world, in terms of market cap. This year, a decade ago, 2 decades ago, it appears to be working its way into kind of Web 3.0 through acquisition. Is almost impossible to remove from your life if you live in the Western world. Chucks off a couple of % of dividend. There are some really resilient businesses that, whatever the weather, you just feel, quite strongly that they're going to have a place at the table over the very long term, and which, most people watching this will have a piece of in the pension fund.
You get companies that have good business model, good management, able to have earnings, resilient balance sheets to deal with all the stuff that you get thrown at as a company. I think there's always very, very good companies out there. And I think it's true as well, just say Microsoft, Apple isn't just a phone company, Amazon isn't just a website, etc. There's examples across we're talking about tech explicitly here, but there's examples across all sectors of very, very good companies that will do better than their peers consistently.
And without wishing to take the punch ball away from the party on that one, there are examples of brilliant companies. There are lots of examples of brilliant companies that haven't done well. Like Cisco in 2000, briefly the largest company in the world. In 21 years later, it passed its recent high from 2000. That's 21. So a 21-year hiatus where you earned nothing from having bought it at the peak. Arguably, it's still a brilliant company over that time period. It's grown its revenues 2.5 times, its profits 4 times. So it's been very successful, but just that didn't justify paying 47 times its earnings back in 2000. So you can have great companies, but if you buy them at a ridiculously great price, they're not great investments.
Which is back to your point around value investing. So all to do with the fundamentals of the company versus the actual price that you're getting in at. So I suppose the wider point you're making, Gary, is actually, even although there have been some shocks and some outperformances over the last 12 months, the fundamental idea of putting your eggs in an awful lot of different baskets via a fund is valid for most pension investors.
Oh, I think so, yeah. And it's not cowardly, to diversify or go passive. All the objective numbers will tell you look active, depending on which stats you look at, 65 to 80%, fail to consistently outperform. I think that passive active debate is a bit more nuanced than that. It's not just one or the other. I think you can have both, but you just probably need to be in terms of where you would spend your budget for active, you need to. That's a critical decision. Look, diversification. It sounds simple and obvious. So many people eschew it though, and don't follow it.
One of the big things that was supposed to diversify portfolios and was supposed to act as a in a non-correlated way to equities until we got into this year, I suppose, was cryptocurrencies, and in particular the most popular one, Bitcoin. So we probably can't really have this conversation without briefly touching on that one, but that hasn't proven to be the case, has it?
No, I've tried to understand crypto. I've bought a book on decentralized finance, which is kind of a related area, but separate to crypto. And I think you need a degree in computer science or something to fully understand. I can't really, so it's kind of in my too difficult pile. But I'm fascinated by this idea that we obsess over the investments we don't make that do really well. So people look at Bitcoin and go, God, that thing's up like 10,000% in the last 5 years. And there's room for lots of misses in a very successful portfolio. That's like, if you didn't own Bitcoin, that's an error of omission. It's just that you lost the potential for growth. The thing you cannot recover from are errors of commission. If you make an investment decision that's actual capital you're losing. So I think there's room for lots of errors of omission. So don't worry and don't obsess about the things you don't own that go really well. So
it's always going to be someone next door who got 12%
Absolutely.
last year and you only got 11 or whatever it might be.
And the guy who lost just as much, he stays.
He says nothing.
Yeah.
He says nothing.
So, but it's a good point. I suppose the third part of our discussion here is, knowing what we know now about what has happened, about what the outlook is like for inflation, for some of the markets we've talked about. What should pension investors be thinking about, James?
Well, I think before we start thinking about that, we need to be conscious of the sustainable investments kind of agenda that's all of a sudden comes centre stage. And whether it's driven by EU regulations like SFDR and IORP to a certain extent, but also actually from demands from our clients. Our funds will need to take a significantly increased exposure or awareness to ESG factors. And I think most of the pension funds in Ireland have either reached Article 8 level or are fast approaching Article 8 level. And then the next stage is obviously to go to Article 9. But I think that's a biggie going forward.
So it's this difference between whether you're kind of shunning abhorrent investments, if you like, or versus actively investing in things which do good. I suppose it's been a pretty challenging year to distinguish that. It's caused a lot of people to revisit their assumptions about what constitutes an ethical investment, hasn't it? Because
absolutely.
Suddenly, actually, if I'm buying, Norwegian oil and gas, for example, that might be, or helping a country defend itself against an external aggressor by funding armaments, that looks very different from September 2022 compared to, buying an ethical portfolio, which is almost pure technology in September 2021. So how do we navigate that for pension investors?
Well, I think the crucial thing is that people need to understand what a fund can do and what it can't do. And a very good example of that is pre-ESG, there was a New Ireland Ethical Fund. Okay, and that came about because various religious orders came to, it was actually BIAM at the time, and asked them to invest the money, but to avoid the likes of pornography, etc., etc. If you start addressing a group of scheme members and say, right, this is an ethical fund, they're all saying, oh yeah, and it's based on the ethos of the Catholic Church, at least half of them will put up their hands in horror. So again, you need to understand your ethics could be completely different to mine. But the key is to understand what the basis of the fund is and what its objectives are, and then you can decide whether that suits your particular, your own ethical standpoint.
Yeah, and one of the things, Ian, is that what it is prompting is a conversation both from pension providers but also advisors such as ourselves with people in charge of governance at group pensions or individual pension investors about what they're looking for, disclosure around what's on offer and all that kind of thing. Is that fair to say?
Yeah, it's incredibly complicated and it's incredibly nuanced and incredibly subjective. I think it's worth saying that various things that fall under the guise of ES or G have been around for a very long time. Like investing in companies with good governance is just a sensible thing to do since the start of investing. I think it's been codified into ESG or sustainable investing, and as James says, you can pick your acronym in terms of regulation that's hitting the market with this at the moment. Our view is I think do understand what your fund managers can do, how they do it, why they do it. There's lots of people who will say they've cracked it and their rating or their exclusions or their tilts are the way to go with it. But it is we're not at a stage yet for lots of reasons to be able to put a fully quantitative lens across many of these things. Now we might get there, and that's a view of myself and Zurich. But it is very subjective, and it's tough to get right, and it's you can have very different answers depending on your perspective as an individual.
Yeah. And even Article 8 is kind of a cop-out, isn't it? Because it's sort of a halfway house. It's a nod towards ESG, but it's not the primary focus, which an Article 9 fund is. So within Article 8, you can have completely different approaches from different investment.
I think it's important, it's worth saying as well, ESG is not climate change.
Sure.
We're trying to do something about climate change. Those terms can often be loosely interchanged. And for some people, ESG is just climate change, but that's not necessarily what it was meant to be. Some of the regulation, I suppose SFDR, just to take that one, was meant to deal with disclosures. It wasn't supposed to be, they've been explicitly saying this, it's not a labelling mechanism for funds, but it sort of has become that way
exactly
for the
that,
market
yeah.
as well.
But
So
I suppose, what is good about that is it's prompting the conversation, and as you say, the D in SFDR, Sustainable Finance Disclosure Regulation, is we, as people who get pensions done on them are able to get our hands on more and more information about that and make informed decisions. So I guess to that extent,
it'll take a while to get bed in, but it's
like
good that it's been raised.
And it's a new set of standards that everyone's kind of wrapping their head around, I suppose.
And from an advisor's point of view, it's an extra layer in the fact-finding process now from the 1st of August.
Yeah, or more work, as I call it.
Well, yeah, absolutely.
So we're all about action, practical actions people can take today to improve their financial futures. So with that in mind, what's the first step our viewers can take, coming off this webinar when they finish watching this session to keep their pension on track? What action would you suggest they consider?
Check where the fund is invested and get advice. Engage with your advisor. I think that's the key message throughout the whole pension journey.
Great, thanks. Ian?
Yeah, get informed and understand what you're trying to do, how you're trying to do it, and make sure you do get advice before you make any big decisions, which can seem very, very attractive at a time of volatility and a bit of angst.
Yeah, there's been a lot of that this year, hasn't there? Just holding your nerve in a tricky situation. Markets up 9%
Markets may have
in
changed.
July, and
Markets might have changed quite a lot, but has your circumstances changed to warrant you doing something?
Yeah, Gary.
Well, I think anybody who's kind of in their kind of 40s or 50s in a pension probably has a bit of a pot built up and fun. So the important thing for at the earlier stages is actually starting one, but most people probably have in their 40s or 50s. I would say the most important thing is just trying to grasp this idea that the risk to you as a long-term pension investor is not whether the variability of the fund is high or it presents the potential for short-term capital loss. That's irrelevant. And once you get this notion that what the proper measure of risk is, I think better investment decisions will come out of it.
Yeah. Great. So there's some great ideas there. Thank you very much. That's all we have time for, so it remains for me to say thank you to our panel for their involvement, and thank you to our viewers today. There are lots more events on throughout this Pensions Awareness Week, and you can also view videos that we shot last year as part of Pensions Awareness Week 2021. So thank you very much, and do log on. All the best.